So thank you very much, Ren, and the other organizer for including the paper in the program. It's very exciting to be here. So I'm presenting my job market paper. Let me just 1 second. Okay, so I'm presenting my job market paper, which is titled "The Impact of Fiscal Policy on Financial Institutions, Asset Prices, and Household Behavior," and I really look forward to your comments. Let me start just by motivating what I do in the paper. So tax incentives on financial activity actually have a major impact on the US federal budget. And this impact is summarized by what the US government officially calls tax expenditures. These are just defined as any tax revenue loss due to special exclusion, exemptions, or deductions. And so in the left panel, in panel A, I show you the total tax expenditures broken down into financial and non-financial activities. And what you see there is that, not surprisingly, since the 90s to today, they have been steadily growing over time, reflecting the extension of the US federal budget. What is more surprising is the total magnitude at the end of 2023, which is around $2 trillion. However, what is instead much more striking is the share of total expenditures that the government is using to subsidizing financial activities. This was equal to 33% during the 90s. It fell during the Great Financial Crisis. This is not surprisingly, right, in the sense that all financial activities slowed down during the Great Financial Crisis. And since then, it doubled from 25% to 50% of the total. And so today, in 2023 at least, the US government was allocating around $1 trillion per year to subsidize financial activities. Now, you may wonder, what are these activities that are so heavily subsidized by the US government? And so here in the left panel, so panel A, I show you the top 5 financial activities by cost as of 2023. And there what you see is that the top 2, dividends, capital gains, and defined contribution, are by far the largest. So they amount together to around $500 billion. Now, to put this in perspective, it is useful to compare them with some of the most studied federal subsidies in the economics and in the finance literature, which are health insurance and tax credit for children. This comparison is very useful because it reveals that dividends, capital gains, and defined contribution are actually larger. They are 2 times larger than subsidies for health insurance and 4 times larger than tax credit for children. And so, motivated by this fact, motivated by the size and growth of these tax expenditure, tax incentives on financial activities, in the paper I ask and try to answer 3 what I think are very important questions and connected ones. So first, I'm going to ask, how does fiscal policy, and specifically tax incentive on financial activities, affect the structure of the financial system? Meaning, how these tax incentives affect capital flows across different types of financial institutions, but also the cost of financial products for households. Second, I'm going to ask whether the capital reallocation in response to fiscal reforms has any effect on asset prices, given that we know that institutions tend to hold very, very different portfolio of assets. And finally, I'm going to ask whether there is any meaningful heterogeneity across households in how they respond to tax incentive. I'm going to ask whether different households are differently responsive to tax incentives and whether this has distributional implication, whether there is any difference in how different households benefit ultimately from these government interventions. So answers to this question are in general very important and are key to understand how fiscal policy and tax incentive on financial activities affect the government budget, financial stability, and ultimately household welfare. However, there is very limited empirical evidence in the economics and in the finance literature that can offer us very precise answer to this important question. So before I go into the details, let me just give you a broad overview of the key findings in my job market paper. So in the first part of the presentation, I'm going to start by showing that capital flows across different types of financial institutions are surprisingly sensitive to changes in tax incentives. And said a bit differently, fiscal reforms have large and persistent effect on capital flows across institutions. Now, to put this effect into perspective, I'm going to show you that the response of capital flows to fiscal reforms explain up to 53% of the long-term growth of aggregate financial sector that currently manage several trillions of dollars in assets. However, there is a caveat, and the caveat is that while households actively take advantage of tax incentives, actually not all the tax savings that are introduced by fiscal reforms are collected by households, at least directly. The reason is that part of these tax savings are actually collected by financial institutions that respond to the increase in demand by raising the cost of financial products And this raise in the cost of financial product is actually pretty meaningful, in the sense that for every dollar of tax savings, financial institutions end up collecting up to 21 cents. Second, I'm going to show you that the large capital reallocation in response to fiscal reforms also has large and persistent effect on the cross-section of asset prices. And more specifically, I will show you that assets that are relatively overweighted by institutions that benefit from a fiscal reform, that are subsidized by the US government, outperform for several years after the reform is passed. They outperform by 13% over 3 years after fiscal reforms are passed. And finally, I'm going to try to study any heterogeneity in the response to these tax incentives across the wealth distribution. Now, answering empirically to this last third question is challenging, at least for the US, and the reason is that we have limited data available at household level. And so I'm going to try to make progress on this question by bringing new household level data that I'm going to describe in very detail and that have a lot of advantages compared to other data sources. But the most important advantage, at least for my purposes, is that they have extremely good and broad coverage, especially of the upper end of the wealth distribution. And there, what I'm going to show you is that there is massive heterogeneity in how different households respond to tax incentives. In particular, wealthier households are orders of magnitude more responsive. And by doing that, they end up earning a tax alpha of around 50 basis points per year, so pretty meaningful. And they can do so by just properly optimizing the realization of capital gains and losses. So by engaging in what in the industry is called tax loss harvesting. And so more broadly, what is the key takeaway of my joint market paper? In my joint market paper, I try to show that fiscal reforms are followed by deep changes, both in the structure of the financial industry and in the cross-section of asset prices. However, there is in some sense a caveat, and the caveat is that these tax benefits are not evenly shared across different US households, but wealthier households are substantially more responsive, and the stronger response is going to have meaningful, important distributional implications. Okay, so this concludes pretty much the. Okay, so this concludes pretty much the broad introduction of my joint market paper. Now, before I get into the details, maybe let me pause and see if there are any questions. If not, I'm going to just first describe the outline and then jump into it. So I'm going to start by discussing the data sources that I use in my joint market paper, and then I'm going to try to address the first question of interest, which is how fiscal policy affect the structure of the financial system, including capital flows and the cost of financial products. And then I'm going to look at long-term implication of the effects that I document in the second part. In part 3, I'm going to study how fiscal policy affect asset prices. And finally, in part 5, I'm going to use household level data to understand the distributional implications of this government intervention in financial market. Okay, so briefly in terms of data, in the my joint market paper, I combine, and to answer this question, I combine several data sources. These are both institution and at household level, and some of these data sources are actually fairly standard. Some of them are instead proprietary. So I'm going to use the relatively standard CRISP mutual fund database that provide information on asset flows, characteristics of mutual funds, ETF, variable annuities offered by a life insurance company. This dataset, however, has very limited coverage of variable annuities, at least before the great financial crisis, and so I'm going to complement it with the Morningstar Annuity Intelligence dataset. I'm going to use then the most classic CRISP Compustat merged dataset. And finally, for the household level analysis, I'm going to use household level data from Addepar. Addepar is a wealth management platform in the US that specializes in services like aggregation analytics and performance reporting for financial advisors. And in the process, they collect information about the portfolios that are advised by these financial advisors. So the data are extremely granular. They are at security level. And I observe holdings at security level, but also flows, returns, and more importantly, realized and unrealized gains across virtually all asset classes that you can think of, like cash, but also equity, fixed income, and also relatively more private asset classes like private equity and hedge funds. However, as I mentioned before, one of the most important advantages of the data is that compared to alternative data sources that are available for the US, like the Survey of Consumer Finance, for instance, these data have extremely good coverage of the upper end of the wealth distribution of extremely wealthy households, and I'll be very detailed on the coverage across the wealth distribution around the end of the presentation. Okay, so with this data, let me jump straight into the first question of interest, which is how fiscal policy and these tax incentives shape the structure of the financial system. Okay, so In order to answer this question, I'm going to use all the reforms passed by the US government since the beginning of the century, since the early 2000s. I'm going to study their effects on multiple areas of the financial system. These areas includes the market for retirement savings, life insurance industry, real estate market, and the asset management industry. And for each of these areas, what I do is that I first identify the financial product that is directly affected by each reform, as well as a close substitute that is not directly affected. And so to give you a sense of what we are going through, the treated financial products are going to be defined contribution plan, variable annuities offered by life insurance company, real estate trust, and ETF. Okay, so let me go step by step, and let me start from how tax incentive affect the development of the defined contribution plan. So I'm going to cover one reform in very detail, but then the machinery you see is going to be quite the same. And so I'm going to cover all the other reform and all the other financial products a bit more quickly. So what is the key source of tax expenditure on defined contribution plan? Well, there are several tax benefits offered by these types of plan, but there is one particularly important, which is contribution to defined contribution plan can be in general deducted from personal taxable income. However, to avoid that these plans are used by households for tax avoidance instead of saving for retirement, what the government does is that it places a maximum dollar limit on how much households can contribute to this plan and still deduct from their personal taxable income. And so if households are responsive to tax incentives, then everything else equal, we would expect that the demand for defined contribution plan and flows to defined contribution plan increase in this maximum limit, right? And so to test this hypothesis, I'm going to use a major reform of the retirement system in the US, which is the 2001 Economic Growth and Tax Relief Reconciliation Act. Now, what this act did, for the first time since 1982, it increased the maximum limit on defined contribution plan, including both 401ks and IRAs. For example, the maximum limit on 401ks increased from $30,000 to $42,000 in just a couple of years after the reform was passed. And so in order to test the effect of this reform on the demand for defined contribution plan, I'm going to run the following. I'm going to use a difference in different design and the following baseline regression. So the outcome variable is going to be represented by flow to institution high in year quarter T. And I'm going to construct it as dollar flows at the numerator divided by total assets of that institution at the denominator. I'm then going to control for style times year quarter fixed effect. This is quite important because I'm going to restrict variation only across different financial institutions that operates in similar styles, so tend to specialize in similar assets. And so this allows me just to restrict variation to institutions that specialize in similar portfolio of assets, and so that very likely have homogeneous exposure to potentially contemporaneous shock that happened around 2001. I'm then going to interact year quarter fixed effect with the treatment status, whether an institution is treated or not, and I'm going to be very, very specific in a second on how I construct the treatment and control group. And I'm also going to control for institutions' observable characteristics, XIT. Now, the parameter of interest that we are interested in identifying is this gamma T, which represents the average effect of the reform on flows to the treatment group after 2001, right? Okay, so how do I construct the treatment and control group? So the treatment group is going to include retirement share classes offered by mutual funds. Now, why these retirement share classes are an ideal product for me is because they are offered by mutual funds and they can be accessed by households only through defined contribution plans. So only through 401ks and individual retirement accounts. I'm going to use as a control then any mutual fund share class that is not a retirement share class. And so let me show you how these capital flows to treatment and control group look, first in the raw data and then what are my estimates. So first, I'm going to, here in the left panel, I show you how the capital flow to non-retirement share class, to the control group, evolved around the 2001 reform. And what you see is that they remain completely flat throughout the period of interest. The pattern is completely different for capital flow to defined contribution plan, to retirement share class. The capital flow to defined contribution plan were completely flat up to 2001. Starting in 2001, you see that they start to diverge. And by the end of the estimation window, they were around 100%. Now, if I estimate, sorry, 1 second. Can you see this, the right panel now?
Yes, yes.
Oh, maybe I mean, I can keep it like this. If it's fine, I can keep it like this. So what you see, if then I formally estimate the difference in difference design that we discussed before, what I find is that the 2001 reform, the increase in contribution limit enacted with the 2001 reform, increased capital flow to defined contribution plan by around 90% in just 4 years. And so it was a very large effect. Now, you may wonder whether this is specific to this sector or is something that is much more general. And so let me now test the effect of changes in all the policy parameters that enter directly into the top two, the tax expenditures that we discussed in the second slide. So income tax rate, dividends, and capital gain tax rate. So I'm going to be a bit brief on this in the interest of time, but if there are questions, I can go into much more detail. So in order to test the effect of changes in personal income tax rate, sorry, Ryan, you have a question?
Yeah, so I'm not quite familiar with these historical events, but does this has some anticipation effects? Because basically you consider this is a natural experiment which creates you a fiscal shock, right?
Yeah.
But
Yeah.
then like whether there is some implementation lag or something like that can give you an anticipation effect, so that investor, before it's actually implemented, the investor can already have some information about that.
Yes, right. That's right. So there are two ways to check for this, right? So one thing, I think this is not really a problem, right? In the sense that for all these, for households to benefit of these fiscal changes, he has to wait that the reform was actually passed, right?
Okay.
The second reason is that there is, if you look at this graph, right, like you can sort of visually check whether there was anticipation effect by looking at what happened before the reform was passed. And what you see is that in none of these experiments you find any sign of anticipation, which I'm not saying it's not there, but if it was there, was negligible. And also I want to mention one last thing, which is if there is anticipation effect, then the worst thing that can happen is that all the effects that I estimating are actually smaller than what they actually are. And so you should take all these effects as a conservative lower bound. Right?
Yeah.
Okay, so in order to test the effect of changes in personal income tax rate, an ideal product is represented by variable annuities offered by life insurance company. Why is the case? Well, the reason is that they share all basically the tax benefit to as defined contribution plans, but there have one key difference, that contribution to variable annuities in general are not deductible from personal income tax. And so a decrease in personal income tax rate should decrease the opportunity cost of households to save for retirement via variable annuities instead of defined contribution plan. And you would expect that a decrease in personal income tax rate increase aggregate demand for variable annuities relative to defined contribution plan. And I'm going to test this hypothesis using the decrease in personal income tax rate enacted with the 2017 Tax Cut and Jobs Act. Second, what about changes in dividend tax rate when an ideal candidate is represented by real estate investment trust? Why is the case? Well, the reason is that real estate trusts are basically corporations that, differently from standard C corporation, can avoid the payment of corporate taxation if they distribute all their earnings to households. So if they have a payout ratio which is greater than 90%. And so given this large payout ratio of real estate trust, you would expect that the aggregate demand for real estate trust is very, very sensitive to changes in dividend tax rate, on the tax rate that applies to dividends distributed by real estate trust. And in particular, there are decrease in the dividend tax rate on the dividend paid out by real estate trust, increase aggregate demand for this investment vehicle. So I'm going to test the hypothesis using, again, the 2001 Economic Growth and Tax Relief Reconciliation Act. And finally, what about effective changes in capital gain tax rate? Well, the ideal candidate for this is represented by exchange traded funds, right? And the reason is that exchange traded funds are very close substitute to mutual funds, but they are publicly traded. This is a key difference because investors in ETF, because ETFs are publicly traded, end up paying significantly less capital gain taxes compared to investors in mutual funds. And so what you would expect is that an increase in capital gain tax rate, increase aggregate demand for ETF, and I'm going to test this hypothesis using the 2012 American Taxpayer Relief Act. Okay, so exactly in line to all the hypotheses that we laid down and what we would expect if households are strongly responsive to tax incentive, I find that in the left panel, the 2017 reform was followed by a large increase in the demand for variable annuities relative to defined contribution plans. the 2001 reform was followed by a large increase in the demand for real estate trusts relative to corporations, and 2012 reform was followed by a large increase in the demand for ETFs relative to mutual funds. Now, another time to go too much in details on this, but how do we make sense of these magnitudes? So how do we compare all these magnitudes? Well, one way is to compute the elasticities implied by all these estimates and compare them with the elasticities to different tax rates that have been previously estimated in the public finance literature. And there what I find is that my elasticities are substantially higher. For example, they are 3 times higher than the elasticity of realized capital gain to changes in the capital gain tax rate, and 10 times higher than the elasticity of taxable wealth to changes in the wealth tax rate. Now, these differences have very important policy implications, right? And are very intuitive to understand. The key feature of my framework is that households can reallocate across different financial products to save taxes going forward without having to change whatsoever their consumption saving plans for the future. On the contrary, in all the examples that I mentioned, households have to take kind of costly action, as to change consumption saving plan in order to take advantage of changing tax incentive. Okay, and so what this result suggests is that while households may appear as inert when they have to change their consumption saving plan in response to a change in taxation, households are actually very, very active in reallocating across similar financial products to save taxes going forward. And this is likely to have first order effects on the US federal budget, like we discussed at the very beginning of the presentation. Okay, so I have also a lot of discussion in the paper about the cost and supply of financial products. Maybe let me skip this part and we can go back to it if I just consider that I'm not gonna have time to go through everything otherwise. Okay, but the key takeaway is, as I mentioned, is that in response to changes, in response to this increase in demand, financial institutions respond by raising the cost of financial products, and then they are collecting a sizable fraction of the tax savings. So not all the tax savings introduced by fiscal reforms are collected, at least directly, by households. Part of them are collected by the financial sector. So instead, what I would like to discuss, which is one of the key results of the paper, is that so far we have discussed, we have studied how fiscal reforms affect capital flows across different types of financial institutions relatively in the short term, right, over an horizon which was 2 to 4 years. But the much more interesting and important question is whether fiscal policy, whether the government can affect the growth of different financial institutions, not only in the short term, but also in the long term. Now, estimating what is the effect of fiscal reforms on an aggregate financial sector is substantially more challenging. It requires to modify the baseline DAD estimate. And so what I do to address this question is to extend the baseline difference in different specification to allow for heterogeneous treatment. And the extension is actually pretty intuitive in the sense that you see that the regression is basically the same as the one that I showed you at the very beginning of the presentation, but there is one key and important difference, is that I now parameterize the treatment effect gamma not only to depend on time, but also to depend on the institution. In other words, I allow the treatment effect to depend linearly on a vector of observable institutions characteristic, which I call Zi. Okay, and so given an estimate of these regressions under the assumption that we can identify properly gamma high t, then what is the effect of fiscal reforms on an aggregate on the aggregate growth of the treated financial sector? Well, we can construct it like quite simply, right? In the sense that we can first take a value weighted average, an asset weighted average of the gamma high t across all institutions in one sector. This gives me the effect of the aggregate growth of on one sector at a given point in time, and we just accumulate that asset weighted average over all the year quarters from t equals 0, which is the year quarter in which the reform is passed, to t equal big T, which is the last year quarter that I include in my estimation window. This estimate GAD allows to identify the effect of all the fiscal reforms that we discussed before on the aggregate growth of these financial sectors. So on the aggregate ETF industry, on the aggregate life insurance industry, and so on.
So your cross-section dimension is at the institutional level?
That's right, institution
Okay.
and year quarter.
Then how do you think that those institutions outcome variable are independent from each other, or there is some network effects?
No, they're not independent, right? Depending on for example, different institutions may share different observable characteristics, right?
Right.
And so, if, for example,
That's
say
going to be captured by this.
that's going to be captured. That's going to be captured. Yes, absolutely.
Right. Yes.
Did I answer your question? Yes, right?
Yes, mostly.
Okay.
Yeah.
Okay. So then, how can we make sense of this estimate G hat, right? So one thing is to compare G hat with the actual long-term growth of this financial sector. Now, to give you some perspective, these financial sector are all financial sector that they currently manage several trillions of dollars in assets. So they are very big financial sector. And so how I construct this measure of long-term growth, I construct it as the value-weighted cumulative capital flow observed for each sector over a relatively long period of time, over 2 decades, between 2000 Q1 and 2020 Q4. And so here in the left panel, I show you G hat over G. So the fraction of this total long-term growth that is explained by the response to fiscal reforms. And what you can see is that fiscal reforms already explain a substantial fraction in the aggregate growth of this financial sector, between 15 to 30%. However, there is a caveat behind these estimates, and the caveat is that these estimates, this number that you see in the left panel, are very likely to be a conservative lower bound of the true effects. And the reason is that the policy parameters that I'm testing changed also outside the estimation windows. And for example, let me give you just one example. Contribution limit on defined contribution plan, right, which was the policy parameter of interest when testing the effect of 2001 reform on aggregate demand for defined contribution plan, changed also outside the estimation window that I considered, changed also after 2005. And the reason is that the 2001 reform index changing contribution limit to annual inflation rate. Now, while this continuous increase in contribution limit is likely to have increased demand for defined contribution plan, this additional effect is not captured by this 21.2% that you see in the far left panel. And so how can we get a sense of the true effect? How can we get a better estimate of the true effect? Well, one way is to use the elasticities implied by my estimate and multiply them by any change in the policy parameter that I observed throughout the 20 years, 2000 Q1 and 2020 Q4. And if I do that, what I estimate is that now fiscal reforms explain between 18 to 53% of the long-term growth of the aggregate financial sector, which suggests that fiscal reforms have not only a large, but also a very persistent effect on capital flows across different financial institutions. And more broadly, because all the institutions that I study in my job market paper all face different capital requirements, regulation, funding structure, they are overseen by completely different regulatory agencies, what this result suggests is that the US government, by changing tax incentives, can affect the growth of different financial institutions and potentially financial stability, not only in the short term, but more importantly, also in the long term. Okay. So with this result in mind, let me go to the asset pricing effect, because one natural question when after we discuss this large capital allocation in response to fiscal reform is whether this large capital allocation has any effect on the cross-section of asset prices, right? And so in order to test this hypothesis, I'm going to focus on one particular reform, which is the 2001 reform that, remember, increased aggregate demand for ETFs. And the reason is that it provides a very clean identification strategy, as it's going to be, I hope, very clear in just a minute. The reason, in short, is that it's going to allow me to restrict attention to purely index mutual funds and index ETF that track predetermined indices. And so for every dollar that we allocate to this type of investment vehicle, we will know in advance how they're going to allocate across different types of assets, right? We know in advance they're going to be allocate that additional dollars proportionally to the weights that in the benchmark that they are tracking. And so how do I try to identify these asset pricing effects? Well, I'm going to propose a new measure that captures the expected increase in the demand for an asset purely in response to the passage of the fiscal reform. And what is the intuition of this measure? The intuition is actually very simple. And now let me go step by step in constructing this measure with you. So for each stock A and year quarter T, I first construct what I call mismatch. This mismatch is nothing but the difference between the weight on stock A in the portfolio of the aggregate ETF industry less the weight on stock A in the portfolio of the aggregate mutual fund industry. So what this difference suggests, if positive, for example, is that that stock that we are considering is likely to be overweighted by ETFs relative to mutual funds. Second step, I'm going to multiply this mismatch by the total assets in the mutual fund.
Sorry, can you talk about this again? I'm a little bit confused. So, so the first one is the portfolio weight of aggregate ETF. The second one is the portfolio weight of aggregate mutual funds. Then, what kind of so here what do you mean by the aggregate mutual funds? You just find a specific mutual funds or something like that?
No. I just aggregate the holdings of all mutual funds.
All mutual funds, okay.
I sum so for example, I take the sum of holdings of all mutual funds on Apple, and I scale by total assets in the mutual fund industry. And I do the same for
okay.
This mismatch is just to say that for some reason, the ETF are overweighting Apple relative to the mutual fund, or they are underweighting Apple relative to mutual fund.
Okay, I see. Now it's clear. Thank you.
Okay, good. So then, however, this measure up to this point doesn't capture any expected increase in demand, right? So how do we convert this mismatch into an expected increase in demand? So first thing, we multiply by total assets in the mutual fund industry. Why? Because now this product captures the expected increase in the demand for a stock in dollar terms if households, in response to the fiscal reform, sell mutual funds and buy ETF. And finally, the last passage is actually the simple one. We just rescale that dollar demand shock by the market capitalization of the stock. And so we just translate this measure into relative terms relative to the stock market cap. This is what I call MAT. This is the ultimate measure that captures the expected increase in the demand for a stock relative to the stock market cap. And so how can we use this measure to identify asset pricing effects? Well, what we can do is that we can estimate a difference in difference design with continuous treatment, in which the continuous treatment is precisely the measure that we just constructed, fixed and constructed, however, just before the reform was passed, so that is not polluted by any equilibrium effects that come out of the reform. And so more specifically, what we can do, we can regress the return on stock A at time t on industry times time fixed effect. So I'm going to restrict variation only across stocks that operate in a similar industry. And then going to interact year quarter fixed effect with the continuous treatment measure. Okay. And I'm also going to control for standard equity factors, big RT. And I'm going to allow factor loadings for each stock to depend on stock fundamentals. So I'm going to allow different stocks to have different exposure to the aggregate equity factor based on the stock characteristics. And so the parameter of interest is this delta T, which captures the expected increase in asset prices for a 1% increase in demand. And so if we estimate this regression, what I find, it's what I plot in the left panel, I find that a 1% increase in demand increases asset prices by around 13% over 3 years after the reform was passed. Now, how do we make sense of this magnitude, right? Because it seems a big magnitude. So how do we make sense, and how we make sure that we are estimating, we identify a proper effect? So there is by now a large literature on empirical asset pricing that has used several settings like mandate, index inclusion, and so on to estimate a macro multiplier of 1, which implies a 1% increase in demand increases asset prices by just around 1%. And indeed, if you compute the price impact in each quarter behind these estimates, I get exactly a multiplier which is just above 1%. And so what is the key takeaway is that my estimates are actually extremely in line with what previous papers have documented, what previous papers have estimated. But there is one key and important difference, right? Is that while previous papers tend to find asset pricing effects that tend to last just for a couple of quarters, and the reason is that it's challenging to find very persistent demand shock. Typically, previous papers have been able to use very transitory demand shocks. Here, what I show is that fiscal reforms induce such a persistent change in demand that the asset pricing effects are also extremely persistent. And you see that they last for several years before flattening out. Now, there is one more broad takeaway of this, which is what I'm actually showing here is that fiscal reforms have not only very large and persistent effect on capital flows across different types of financial institutions, but they also have the capacity to induce very large and persistent effect on the cross-section of asset prices. Now, if this difference in different design seems a bit maybe, I don't know, too complicated, or there's another very natural way to provide the same result, which is we can just estimate a factor model stock by stock, but crucially by also including a time dummy, which is equal to 1 in all the year quarters after the reform is passed. So the inclusion of this time dummy allows me to identify the change in alpha for each stock after the reform is passed. And what I can do is that I can just average this change in alpha for different quantiles of the treatment measure, of the M measure that we discussed, that we constructed before. And this is what you see. You see that consistently with all the hypotheses that we laid down so far, stocks in the bottom quantile, so that are overweighted by mutual funds relative to ETF, experience a strong decrease in alpha, and stocks that are in the top quantile that are strongly overweighted by ETFs relative to mutual funds experience a large increase in alpha. Okay, so this concludes pretty much the discussion of the effect of fiscal reforms on the structure of the financial industry and on asset prices. But I think at this point of the paper, there is one key, very important and missing piece, which is how different households respond to this tax incentive, how different households optimize taxation, and especially, is there any heterogeneity in how different households respond to tax incentives? Now, throughout this part of the paper, I'm going to focus on how households optimize capital gain taxes. And the reason is that capital gain taxes are of first order important to understand, right? Because if you remember the very first graph that I showed you, like in the very second slide, they are part of the second largest source of tax expenditure. And so they are of first order importance for us to understand. So what I'm going to do to make progress on this important question is I'm going to bring in new household level data from Adepar, and I'm going to now give you some more details on the data. So Adepar is a wealth management platform that specializes in analytics like aggregation, performance reporting for financial advisors, and has by now reached extremely broad coverage of the wealth distribution of households financial activities. Adepar currently manages around $5 trillion, it covers $5 trillion in assets that are managed by over 1,000 different financial advisors. So extremely broad coverage of households financial activities. These data also have several advantages. As I mentioned at the very beginning, they have extremely broad coverage of the upper end of the wealth distribution of ultra net worth households, but they also have other important advantages. First, they are at relatively high frequency, they are at monthly frequency, and they span the period from January 2016 to March 2023. Additionally, they are extremely granular. They are at security level, and I observe holdings, flows, returns, but also more importantly, realized and unrealized gains across all asset classes that you can think of. And so I'm going to focus throughout on what we defined in a previous paper with Xavier Gabex, Ralph Koijen, Simon and Monte.
Is this data only accessible through Chicago, or is this by some special subscription?
No, I think no, it's not. I don't think it's proprietary, so it's not possible to subscribe at least yet.
Okay.
So yeah, it's an extremely.
So you have some contact there, so to get.
That's right. That's right.
Oh, I see.
So I'm going to focus throughout on what we defined in the previous paper with Xavier, Ralph, Simon, and Moto as liquid asset classes, which are broadly publicly traded equity and fixed income security, mutual funds, and ETFs. Now, why I restrict to these types of securities? That the key objective behind my analysis is to understand how households trade and rebalance to just get to benefit from tax incentive, to respond to tax incentives. And so I want to focus the attention on securities that can be traded relatively liquidly in public markets. And so before we get into this, let me provide some summary stats. So first, in the left panel, I report for different groups along the wealth distribution, the average wealth of households in that group in $1 million. What you can see is that in the bottom quintile, so for households in the bottom 20%, they have on average $200,000 in wealth. But as we increase wealth, along the wealth quintiles, wealth increase dramatically. And at the top 1%, households on average have $200 million in assets in financial wealth. Now, there is another pattern which is quite striking, I think, that emerged from the data, which is here in the right panel, I plot the fraction of households in each wealth group that are advised by different types of advisors. And what you see is that as wealth increase, households become less and less advised by brokers, dealers, and independent advisors, and more advised by family offices and private banks. Now, this gradient I want you to keep in mind because it's going to be very important in 1 second. And so, to kick off the analysis, let me define 2 important measures. These are for each investor I at time t, I construct unrealized gains and losses, which are very simply defined as total unrealized gains for each household in each year month, relative to total assets, total wealth. And unrealized loss I define in the same way. And so let me start just by plotting how these look across the wealth distribution. So first, if you plot unrealized gains, what you see is that they are monotonically increasing in the wealth distribution, suggesting that households have a much larger fraction of their portfolio in unrealized gains. For unrealized loss, this is completely symmetric. You see that unrealized loss decreases substantially by a factor of 4 as you go from less wealthy to wealthier households. And so these patterns already suggest that wealthier households realize loss at significantly higher rate, and so which indicate much greater tax awareness, right? They realize capital loss at significantly higher rate because capital losses can then be deducted from capital gains, thereby reducing their tax expenses. But let me formalize this a bit more precisely. So to do that, to establish this a bit more formally, what I do is that first I construct 2 additional measures. These are realized gains, capital gains realized by household high in year month t, rescaled by initial wealth, and similarly for realized loss. And I then run for each wealth quantile G a very simple regression. I regress realized loss on unrealized loss in the previous year month, plus a set of controls. Now, the key parameter of interest in this regression is represented by this gamma G of I, which represent the fraction of loss that households in a given wealth quantile realized on average in each year month, right? And so here in the left panel, I report the fraction of gains and losses realized on average by households in different wealth quantiles. And what you see is that you see a quite striking fact, right? In the sense that households across the wealth distribution realize a very similar fraction of gains for every dollar of unrealized gain in their portfolio, but the pattern for losses is extremely different. Households in the bottom 20% realize around 1/10 of the loss in their portfolio, and as wealth increase, this fraction increase exponentially, and it's about 30% for households in the top 20%. Now, one potential hypothesis behind this is that wealthier households are much more sophisticated, and so they trade much more rapidly compared to less wealthy houses. In other words, less wealthy houses may be just more inert, and they respond to tax incentive, but they just respond with a delay. And so to answer this question, here on the right panel, I report the cumulative fraction of losses realized by different group of households over up to 12 months ahead. And what you see is that inertia cannot really explain these results. What you see is that wealthier households realize more capital losses at any horizons. If anything, the gap keeps increasing as the horizon gets longer. Okay. So another very important analysis is, and this goes back to the stylized facts that I mentioned a couple of slides ago, is what can we say about whether this behavior is correlated with the fact that households are more tax sophisticated because they can access very efficient saving technology, because they can access very sophisticated advisors like family offices and private banks? Well, this is relatively easy to establish in the sense that we can repeat the exact same analysis, but instead of looking for heterogeneity by wealth, we look for heterogeneity by type of financial advisor. And really, I find another important result, which is if you look at the gradient by advisor type, this is actually substantially larger than the gradient by wealth. And what is very striking is that private banks really stand out as the most tax sophisticated advisor. This may be surprising, right? Because family offices are typically associated with very sophisticated types of advisors. Private banks are actually much more sophisticated. And why this may be surprising, it's very consistent with recent industry trends. Recent industry trends that have seen a massive growth in assets managed by households in tax-aware accounts that are now above $2 trillion. And this growth has been mainly driven by private banks like Goldman, Morgan Stanley, and so on, that are really specializing in the optimization of capital gain taxes precisely for very wealthy households. And so putting everything together, this difference in the response to tax incentives, the natural next question is to ask whether it carries any meaningful distributional implication, whether it has meaningful power to explain heterogeneity in after-tax return. And so here what I plot is the tax expense, the expense of households due to capital gain taxes across the wealth distribution, right? This is already expressed relative to their initial wealth. And here what you find is that while less wealthy households pay around 1% in capital gain taxes every year, the very wealthy households pay around 50 basis points. Now, this is for households around, the left part is for households that have around $100,000 in wealth. And then you increase up to households that have $50 million in wealth, and you get this gap of 50 basis points. Now, this gap of 50 basis points is actually pretty substantial, right? The reason is that it can be achieved, and it is achieved, by very wealthy households, by purely optimizing capital gain taxes, and at the cost of very limited incremental risk in their portfolio of assets, right? Because it's purely achieved by engaging in tax loss harvesting. Okay, so this pretty much, I think I'm very in time. So let me just conclude. So what I try to do in the paper is I use a new empirical framework and new household level data to study the effect of fiscal policy on the financial system and household behavior. And so this question is very important to understand how fiscal policy affects the government budget, financial stability, and household welfare, but we have surprisingly limited evidence on this. And so what are the key findings in my joint market paper? Well, first, I showed that fiscal reforms are actually a very powerful tool to redistribute capital within the financial system, although there is a caveat. And the caveat is that financial institutions end up collecting part of the tax savings that are in principle destined to households. Second, I showed that fiscal reforms have not only large and persistent effect on capital flows across financial institutions, but also very large and persistent effect on the cross-section of asset prices. And finally, I showed that, however, these tax benefits are not evenly shared across different US households. Wealthier households are substantially more responsive, and the stronger response increased the returns at the top by around 50 basis points. Now, I think my joint market paper hopefully raises a lot of several interesting questions for future research that lies sort of at the intersection between asset pricing, public finance, and household finance. Now, I think one thing that I don't do in my joint market paper that I will do, however, for sure in the future is that I think it would be very interesting to understand the normative implication of these estimated effects, right? To use these moments to calibrate or validate normative models that have two important features, that have rich heterogeneity both across institutions and across different households. Second, I think a natural question to ask, which is, I think, more related to the spirit of this conference, is to ask whether there is any cross-country relation between the fiscal policy actions that different governments have taken over the last several decades and the institutional structure of different countries. Now, I think this would be a very important question, and the reason that it would connect strongly with one very famous presidential address by David Sharfstein in 2018, where it shows that there is huge correlation between the variation in institutional structure cross-country and variation in the development of the financial system. Well, here in the second bullet point, what I simply say is that one potential source that could explain all these different institutional structure across different countries could very well be different fiscal policy actions. And three, I think ultimately what we want to get is to the real effects. And so I think one natural question to ask is whether all this capital reallocation and these asset pricing effects have any meaningful real effects in terms of equity issuance by firms and potentially in terms of investments. So thank you very much again for inviting me to present, and let me pause to see if there are any questions before we conclude.
Yeah, many thanks to Federico for this great presentation, and the paper is very interesting. So it especially I'm particularly interested in the last finding. It seems that this tax incentive actually changed the distribution of the wealth to some extent. But isn't that the case? The wealthy people becomes wealthier because for many changes they can make use of it, right?
That's right. So I don't take normative. So I don't think these results can establish any normative implication, right? In the sense that true, wealthier people may get wealthier because of taxation and because they have access to very sophisticated saving technologies that can help them to optimize taxation. But I think this is not the end of the story, right? In the sense that because wealthier people then invest more in financial market, this could create general equilibrium effects like the increase in asset prices and so on that could benefit everybody, right? So I think in this paper, I don't think I can get to normative. I don't take a normative stand. But I think it's the natural next step to include these moments to validate or calibrate normative macrofinance models with fiscal policy and with rich heterogeneity completely.
Right, right. And now you have this very detailed data information. You can actually make use of it to study many different topics, not just the fiscal policy part.
Yeah, indeed, one other thing that I think it would be I mean, for sure, extending this analysis as much as possible, I think would be one. But also, I think another question that I had sort of in the back of my mind was about monetary policy, whether there is any difference, and I think that would also be an interesting question.
Yeah, definitely.
And
So,
it's gonna come in the
any other
future.
question? Yeah. If there are no other questions, maybe we just conclude here. Many thanks to both Nisha and Federico for contributing to our Rising Star seminar series. So this year we have 7 wonderful presentations. Our Rising Star seminar series cannot happen without your contributions. We also wish you best luck in the job market. We are very confident that you will find a very good job in the market this year. We are looking forward to hearing your good news. And let's just stop here today and let's stay in touch. Okay. Have a good one.
Thank you very much.
Thank you. Thank you. Bye.